Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Rupert West of Puma Investments to talk about Puma VCT 13. So first off, Rupert, tell me about Puma and also give me a little introduction to yourself.
So Puma is a fund management company. It's involved in growth, property and listed equities. And there have been 26 Puma funds to date, the first in 1996. So as a platform, the wider corporate group, we've been investing across a series of business cycles, which is very important, particularly in a climate like this that we're seeing today. I was at Barclays Capital in the last crisis, so again, I've seen sort of firsthand the impact of waves in the business cycle and severe stress on the economy. Puma as a group gives us a lot of resource. So I like to see us as we try to act as a sort of best of both worlds. My team is a specialist growth investment team, but sitting within that wider corporate platform that gives us a lot of resources to draw upon. I started off in a consultancy side of a major professional services business and then moved into investment banking, first emerging markets, then UK focused, and then joined Puma and its parent over a decade ago and have been involved in a series of the institutional funds it's run and increasingly then the VCTs and now head the Puma's private equity division.
Tell me about the VCT, so how much is in it, what it aims to do for investors, the types of companies you've already got in it.
So the aim of the Puma VCTs is really very simple. We look to deliver great risk-adjusted returns to our investors, to our shareholders. And we do that by taking exposure to professionally run scale-up businesses. And really, if you're investing in UK small-cap growth, the VCT reliefs are so compelling. You have to be in that space. You have to be offering that to your investors. But that doesn't mean you have to invest in startups. You can invest in what we term scale-up businesses. So typically 2 million plus revenues. And we work with a portfolio of businesses like that. We work with them very closely and we seek to build up proper diversification. So not just a large number of businesses all doing broadly the same thing in the same sector, but different businesses in different sectors doing different things. So Puma VC 13 that we're bringing back to the market here is a relatively small VCT. It's about 15 million. It's got 8 positions in 6 different sectors. And we see that as an opportunity. We're coming back to market because that portfolio is there. It's performing well. It gives new investors exposure, direct exposure to that platform of businesses. But post this raise, we'll have a relatively high proportion of new cash to exploit the environment that we see today, the post-COVID growth environment.
So let's talk about your investment strategy. What types of companies are you looking for?
So at its simplest, we look for 3 things: proven market fit, experienced management, and then a disruptive business model selling into a big established sector. So I'll try and bring that to life. So proven market fit, we're not taking product risk. And we look past, we don't want to judge whether a product works. We want the market to tell us that it does and that there's demand for this. We look beyond product and beyond customer because in fact, landing a big customer can potentially mean that you fit the needs of one esoteric customer, but not actually the market. So that's a sort of a judgment of breadth and success of the company. And to give context to that, the investments we made last year, the average revenue of these businesses was 5 million. And that's the new investments that we made, not amplified by follow-ons. So 5 million revenue. So reasonably successful businesses in their scale-up journey. And that helps us judge how they're being run, demonstrates that they've taken those first steps to scalability and can move from an entrepreneur-driven startup to a successful corporatized scale-up business. That flows to the second point about experience management. Whilst we back disruptive businesses, actually, we feel you need to know your sector in order to know how to disrupt it. You need to know the rules to break them. And again, a statistic to back that up, the last 5 businesses we've backed, the average age of the CEOs is 42. So these are not children. These are people with experience running proper businesses, for want of a better word. The third is a theme that we really like, this idea of a disruptive business selling into a big established sector. So we're not trying to create that sector. The need is there. We're trying to service that need in a better disruptive way. So I'll try and bring that to life a little bit, talking about a portfolio company that's in VCT13 called My Kind of Future, by a great guy called Will Ackerman. And this business started out working with major blue chip clients, big hirers, trying to help them extend their reach beyond the traditional milk round run and boost engagement with the people they were trying to hire into their business, which helped them straight away from a cost perspective. Costs of recruitment are very high, costs of running a milk round process are very high, and costs of attrition over that process, so people you want who then leave or leave shortly after joining, is very expensive for these companies. So that was the money saving angle. And that's built out to be a digitized platform for HR needs for these big corporates called Connector. That's the platform name. And so the business is solving companies' HR needs in a scalable, digitized way that allows them to have cost efficiencies, but also to provide best practice right across their organisation by flowing that out in this sort of scalable digital fashion. So that's a neat example, really, of what we see as the disruption being in how to provide a service that is already needed, that has a big market, big established market.
Yeah. And are there any other recent companies you've invested in that you want to talk about?
Yep. A recent one that we actually closed during lockdown in a relatively tense final few stages is a business called TicTrac, and that's a health and wellness and fitness and nutrition and the full gamut of that sort of offer digital platform. The trick for this company, the sort of what we really like about the thesis, is that whilst it can compete with all sorts of other direct-to-consumer providers that offer meditation advice or nutrition advice, this company works direct to corporates and largely big insurance companies as its clients. So it has large, stable, multi-year contracts, giving it certainty of revenue so that it can build up the quality of content. And part of the investment thesis and what it actually did brilliantly during lockdown is not pivot but augment that offer with a smaller scale SaaS offer for corporates, for smaller corporates, offering again the same access to the same platform of digital provision, but on a free trial basis. And because of the scalable approach, it was able to do that. And the conversion rate from free trial to paid customer, I won't give you the stat, but it's incredibly high. And that really gives the company and us confidence to invest in the sales team, boost that out, continue the growth. So quite a neat fit with the current needs of employers to meet their staff's welfare and health needs in a potentially remote digital fashion.
And how's COVID affected you and your portfolio companies?
COVID was a busy time. Clearly a lot of uncertainty. That's really the critical piece. Uncertainty more so than a conventional economic downturn, because there is the unknown of the actual virus as the stimulant, but then severe unknown in the policy response and the sort of unprecedented nature of that and what the outcome will be. So our first response, I suppose, was to work even more closely than normal with our portfolio. We anyway work closely, but we increased our full monitoring cycle, which is normally monthly. We increased that to weekly, and we laid on, leaning on our advisors and using our own resources, we laid on a series of sort of specialist advice, conference calls and briefing notes to our portfolio around employment law and the government support schemes, cybersecurity with everyone working at home, things like that actually were important and they really needed to know, and they were critical issues at the time. But we didn't want them to have to be distracted by that. We wanted them to be able to focus on the extreme volatility that they feared might be coming, and in some cases were. So that was our sort of first response and how we helped. Several of the portfolio have innovated to great success, and I've mentioned TicTrac, My Kind of Future, with their digital offers, both did well on that in that space. We've had some great winners from this time, and I'll mention one that had a little bit of luck in it, and I think it's incumbent on us all to accept that there is a little bit of luck in this stuff now and then. So we have a cycling business, Le Col, that makes high performance cycling equipment for road cycling, so a big growth sector. And we'd made a small follow-on investment into this business at the tail end of last year with a highly ramped up marketing strategy, some new merchandising skill sets, some hires into the business. But whilst it was performing very well before, the boost of everyone having time at home and no commute and the government effectively saying go cycling or else was a great boon, and that business has performed exceptionally well.
And have you had any exits yet? Clearly it's early days.
So we had a series of exit plans for this year across the portfolio which have been altered and set back a slightly unknowable amount. So nothing recent to talk about in that space, but there's some very interesting activity in several of the sectors we're invested in. So I'll come back and talk to you about that next time.
Rupert, as we know, all VCTs are risky. All your business is also quite new. How risky is it? Is there a sort of typical failure rate you would expect?
This is a risky activity. These are smaller businesses, although I think all I can say is that all things being equal, we would expect a lower failure rate for our strategy than across most of the market, because we are focusing on those scale-up businesses with more professionalised structures, and then we work very closely with them to help them augment best practice.
By nature, would that mean you're also targeting slightly lower returns?
Yes, on a per case basis, we are not targeting 10, 15 times return on each investment. That must be looked at in connection with the risk being taken. So our strategy is to deliver 2 to 5 times return per position as a sort of credible case and have fewer failures. And in fact, we build in across our process, through how we select businesses, how we structure our investments, the legal protections we give ourselves, how we work with the businesses, how we draw upon the bigger resources of Puma and its wider corporate group to support our companies. Everything we're doing is trying to shift the potential return profile so that we have fewer failure and complete downsides, and we're shifting out the probability, we're increasing the probability of a moderate to good to exceptional return.
And finally, if I want to invest in a VCT this tax year, why should I choose you?
I think if you want exposure to serious businesses run by credible, serious people in a VCT looked after by a resilient, long-established manager that knows what they're doing in the VCT space, where there is an existing portfolio of solid, exciting companies, but this raise will also lead to a high proportion of new cash with which to exploit the environment, then I think we're the VCT for you.
Rupert West of Puma, thank you very much.
Thank you.